afternoon for this seminar, or good morning in the United States, because I see there are also some people from across the Atlantic participating in the seminar on derivatives and sustainable finance. The seminar is organized by CEPS-ECMI. CEPS is a think tank in Brussels. We work together also with the European Capital Markets Institute, but we're organizing this briefing together with ISDA, the International Swap and Derivatives Association, on which also the CEO, Scott O'Maya, is present and will say something about this in a moment. We're happy to welcome you for what is an interesting issue, an interesting debate. What can derivatives markets do in the sustainability agenda today, which is a study which we have done in cooperation with ISDA or sponsored by ISDA, but as CEPS, as a think tank, independently trying to shed some lights on this issue about how derivatives markets can contribute to realizing the agenda. We have 4 speakers, or 5 speakers. We have my colleague Apostolos Tomadakis, who will be introducing the report in a moment. And then we have 4 people who will react upon our findings. We have, in addition to the 3 persons who were already announced, also a representative from the European Commission, Hannes Hutainiemi, who works in the unit dealing with these matters in the European Commission and DG FISMA, dealing with the sustainability agenda or the sustainable finance work. Then we'll have Scott O'Maya from ISDA, who will react from an ISDA perspective, but then we have a sell side and a buy side representative also explaining how in their day-to-day work they are using derivatives in the green finance products which they sell or which they use in asset management. We have Bernard Koopman from ING and Clive Emery from Invesco. Unfortunately, we don't have a good gender balance in this seminar, but I hope, let's say, will forgive me for that. We at CEPS normally have the motto that we want to have every seminar gender balance. I think this is the first webinar which we have, and all the webinars which we've organized since the beginning of the crisis, which is not. So please accept our apologies for that, but it will certainly remain an interesting meeting. As I said, this format of this meeting is about, will last until a quarter past 4 our time, quarter past 3 British time. And then of course a difference for the United States, 1 hour and 15 minutes. We have these 5 speakers who will, at each of them about speak 5 to 7 minutes. So until about a quarter, 45 minutes long in the seminar, after which there is time for questions. As you know, let's say we're using Zoom, you can use the Q&A box at the bottom to raise questions, or eventually the chat box as well. We will try to take these questions. If you want to raise a question in person and want to be visible on the screen, we can also organize for this, but in that case, you need to signal us eventually with a hand, and the person who's the operator, Beatrice, can help you, let's say, to eventually come on the screen if you want to be visible when you raise a question, but please raise it in advance. The study which we're presenting today is available since this morning on the website of CEPS, ceps.eu, also on the website of ECMI, which is eurocapitalmarkets.org, and on the website of ISDA. So if you want to find more about what we will be saying, you can find all the information in there. This is probably one of the first studies on this subject, as far as I remember. And of course, that's why we will attracted CEPS to do this study in sponsorship by ISDA, is because it's kind of made us curious. What is the role which derivatives markets can play in sustainability? And basically, to our great interest, we've seen, let's say, there's a lot where derivative markets play a role or could play a very important role. I think even more importantly, as we've seen as a result of the COVID crisis, which has not only focused the attention on the environmental factors, but also on the social factor, the S of the ESG factors. And we see in both cases, you see that derivatives markets can play a very important role. And that's what we want to do in this study. But that's also what we want to highlight in this seminar today with these different participants to help you to understand how crucially important derivative markets are in also fulfilling the sustainability agenda. I move to Apostolos, who will briefly present our findings, and then will be followed by the other speakers. Apostolos.
Thanks, Carl. So let me, I would like to use the time a bit that I have to say a few things about what was the main aim of the study, or why we did this study, what was the purpose, and also put a bit context into the discussion that will follow later. Of course, when we talk about sustainability or sustainable finance, derivatives may not be the first thing that comes to someone's mind. And that's why this study was very interesting, to see exactly what are the futures, what are the characteristics that can make derivatives a useful tool, an effective tool from a sustainability or sustainable finance perspective. Derivatives, of course, exist for hundreds of years. Sustainability as a concept also exists for a lot of years, but it's only the last 10 or so years that moved to the top of the global policymakers agenda, and of course also in Europe. In Europe, it was in March 2018 where the Commission introduced the Sustainable Finance Action Plan, an action plan that will allow Europe to meet its climate and energy targets according to the Paris Climate Agreement. And of course, the main pillars or the main aim of this Sustainable Finance Action Plan is first to channel or reorient capital towards sustainable investments. Second, to manage financial risks stemming from environmental, social, or climate issues. And third, to promote transparency and a long-term approach into financial and economic activity. Of course, many things happened since March 2018. We have a new commission, a new, let's say, target, which is the European Green Deal, the aim to make Europe the first climate neutral continent, but also we have COVID, as Carlo mentioned, which above all other economic, social, health implications, also has important environmental implications. And of course, now we are going to have a renewed strategy, but Hannes will talk about that in a few minutes. Now, coming to derivatives, of course, it's important to understand what is their role, how they can help. The most important aspect, let's say, of characteristic of derivatives is that they offer a tool to both issuers, banks, but also investors, asset managers, retail institutional investors, to manage risk and hedge, to manage their exposure and hedge risk, actually. And to throw some numbers to the table, for Europe to achieve its climate and energy goal, it requires an investment of about 1.2 trillion. Of course, this is a big amount. According to latest estimates, Europe is not on track to hit this target. There is a gap of about 1.8 trillion by 2030 that it's missing. Of course, this number refers only to climate and energy alone. If we consider other sustainably related activities, such as water, transport, waste, logistics, circular economy, and so on, this gap can increase up to 2.5 to 3 times. So there is a substantial amount of money that somehow has to be raised. And here it comes what derivatives can do. Of course, to be able to significantly, let's say, raise such capital, the first thing that you have to do is the ability to hedge your risks and exposures. And this is how derivatives can contribute to that. As one of the biggest global financial markets, have an important role to play. Banks, for example, can use derivatives to hedge credit risk exposure of their borrowers, and by doing that, free up capital and increase lending supply, or the supply of credit towards sustainable investments, for example. In this study, we have a lot of examples of how derivatives can be used by insurance, pension funds, asset managers. So I'm not going to talk about that. And of course, this is the one component, how they can help raise the necessary capital needed, but also how to help companies hedge the risk, the financial risks, but also risks coming from ESG-related issues, from climate and environmental risks. This is an important component as well. Transparency is also very important for both derivatives and sustainable finance. I'm not going to talk about the transparency due to the post-global financial crisis regulations. Scott will have more to say on that. But I'm talking about the transparency which comes from this price discovery mechanism, the price discovery role that derivatives can play, the transmission of information, of price information. Derivatives can change the wealth of information publicly available, and those contribute in establishing the market price based on the equilibrium between buyers, sellers, supply and demand, and so on. So they have an important role to play on that, to help investors, traders, to make better assessment of risk, portfolio management, and also investment decisions. Transparency, of course, can have other benefits in liquidity or to benefit competition and so on. But also another important aspect is the long-term component that derivatives have. Of course, someone can argue that the post-global financial crisis regulation created incentives for asset holders to reduce the risk and the duration of the investment. So this means that investors tend to concentrate their holdings in the shorter term and lower risk spectrum of investable assets. But as we know, sustainability is about long-term component, long-term forward-looking approach. Of course, another important thing that we need to distinguish here is the difference between short-term and short duration. Because an investment or a financing operation with a short duration and lower maturity is not necessarily or should not be confused with short-termism. Derivatives can, as a tool, support both long-term and short-term investment strategies, rather than offer an indicator of the type of strategy undertaken on that. So this is another important component of the derivatives. I'm not going also to discuss, I mean, there's the report, there's detailed explanation about the regulatory efforts, let's say, behind the sustainable finance. Hannes will say more about that, the taxonomy, the eco-label, and so on. But I wanted to highlight and close with that the main aim of this study was essentially to make the link or to make the connection between derivatives and sustainable finance a bit more evident. To think that, yes, can be connected. Derivatives have an important characteristics that can be useful for sustainable finance, for the green transition that we want to achieve. So with that, I would like to finish actually and pass the floor back to Gary.
Thank you, Apostolos. If I could follow up with one quick question, since we are working for a think tank, what is your main recommendation to policymakers before I move to Hannes? What is your finding which you believe somebody in the council, in the commission, politician needs to know?
I mean, the main recommendation is that, yes, derivatives can be helpful. I mean, of course, it's up to the regulator or how derivatives can be an instrument for investment funds, for asset managers, how to make the use of derivatives easy and not complex, perhaps. And yeah, it's an open-minded approach that, yes, derivatives as other financial instruments can be helpful in that direction.
And you feel that this is not sufficiently known, or the public at large is not aware of that?
I mean, I don't think that the public is completely aware. As I said, when we're talking about sustainability, I don't think any retail investor, for example, will come with the notion of derivatives straight to his mind. So it's something behind there, and this is the first study that I think tries to achieve that and a bit shed some light on that direction.
Okay, thank you, Apostolos. We move to Hannes. Hannes was not formally announced initially on the program, but we are very happy that he managed to join us. Hannes works in the unit in DG FISMA, European Commission, dealing with issues related to the sustainability agenda. So I'm very happy he managed to join us, and will say us briefly, probably react on the studies, but that will be a bit difficult because he only could confirm this morning, but at least also tell us where we are in implementing the sustainable finance agenda of the Commission. Hannes also cannot stay until the end, so yeah, you have to listen carefully to what he has to say. Hannes.
Thank you, Karel. Thank you for the invitation to join the meeting. And yes, indeed, sorry that I can't stay until the end, and sorry that I can't join you via video link, but only by phone. But nonetheless, I'll try to give you a brief overview from our side on where we stand on the sustainable finance side. And as you said, more of a run through of the policy situation from our side rather than a reaction as such to the report that you are discussing today, which itself does merit discussion and seems very interesting. As you just heard from Apostolos, the work on sustainable finance in the EU has been picking up a lot in recent years. He referred to this 2018 action plan, on the basis of which we've been working until now. Notably, several pieces of legislation were announced and have since been adopted pursuant to that plan. Chief amongst them, notably this taxonomy regulation, which was formally adopted by the Parliament and Council a few weeks ago. And as you may well know, this taxonomy regulation sets out a framework to categorize economic activities and investments as environmentally sustainable. And what we have been doing most recently in the Commission is to develop a number of delegated acts implementing measures pursuant to this regulation to specify the details of when that would be the case and to define so-called technical screening criteria for when economic activities would qualify as sustainable. We're doing this on the basis of extensive work prepared by a group set up by the Commission, the Technical Expert Group, which finalized its recommendations to us at the beginning of March. And we are due to adopt the first delegated act, one of two, by the end of this year, on climate change mitigation and adaptation objectives of the taxonomy, and then another delegated act at the end of next year on the other four objectives, which have to do with water conservation, biodiversity, pollution prevention, and circular economy objectives. There's another delegated act as well, which is keeping us busy, which has to do with disclosures for financial and non-financial undertakings as regards their the degree of alignment of their activities with the taxonomy. But that is at a very early stage, but we hope to be able to launch work on that very soon, because that is also due for adoption in the middle of next year. That ties in with another ongoing piece of work, which many of you will probably be familiar with, involving the review of the non-financial reporting directive, for which a consultation closed there a few weeks ago, if I'm not mistaken, and for which proposals are due early next year, I believe, is the current planning. And this may have an impact as well on, for example, these disclosures that companies have to do as regards the degree of alignment of their activities with those in the taxonomy, if, for example, the scope of the NFRD were to evolve. Another very crucial, timely milestone at this point in our work is the setup of a new platform on sustainable finance, which will take over from this technical expert group in advising the Commission on issues to do with sustainable finance, in developing, for example, the taxonomy further, in refining it as the years go by and as technology and environmental objectives evolve. We have launched a call for applications for this platform last month, I believe, and the deadline, I think, is today, if I'm not mistaken. So if you haven't already submitted your applications, you have to be quick about it. I think this has generated a lot of interest, and last I heard, there's been hundreds of applications already. So we will have a busy time now over the summer to filter through those and hopefully be able to launch the work of the platform as planned sometime in the next few months, September, October or so. There's also work going on several fronts on ideas to mainstream sustainable finance tools and priorities in public expenditure to do with objectives, for example, under the Green Deal and the post-COVID-19 recovery package. And we are working with several DGs across the Commission to see where the toolbox that we're putting in place, for example, the taxonomy, could in some ways be utilized to further the sustainability agenda in relation to public spending at the EU and national level as well. And then maybe just two more points. We are working on the international front as well with several partners. We've set up a platform on sustainable finance, international platform on sustainable finance with a number of jurisdictions. I believe we're 13 jurisdictions in total now, representing about half of the world's population, GDP, and emissions, including China and India. And the purpose of this platform is to explore common ground in respective approaches to sustainable finance, where measures have already been taken, where regulatory measures, I should say, have already been taken, and to see where there could be scope for further alignment to help further mobilize capital and close some of those investment gaps, which Apostolos referred to in his overview just a few minutes ago. This platform was launched at the beginning, in October last year, so it's still relatively nascent, but we've already been able to get up to speed and notably start a working group with China on comparing our respective taxonomies and to see where we could achieve where there might be common ground to facilitate some of these objectives. And then finally, my last point is on the strategy, which I think Apostolos also referred to. As announced in the European Green Deal, there will be a new revised sustainable finance strategy to reflect the heightened level of ambition of the Green Deal. And this has been prepared through a consultation, which actually closed yesterday and generated a good response rate as well, over 650 replies, if I understood correctly. And the thrust of the feedback seems to be very positive, very supportive of the sustainable finance agenda and pursuing it further, going further than we have thus far, being more ambitious, etc. And I think probably this is where your work on derivatives probably best fits with our work, and I'm sure we can explore a lot of common ground and interesting ideas on that basis. So with that, I think I would close, and indeed happy to take any questions either now or slightly a little bit later, as it suits you, Karel.
Thank you, Hannes. If I can have an immediate follow-up question, let's say there's not immediately a question which, I mean, there's one question in the question box, but not one for you probably. But what I want to ask you, let's say, since Apostolos mentioned these huge sums which are needed to finance the sustainable finance agenda, sustainability agenda, I mean, what we are doing, what the EU is doing, is it not too much constraining this, or is it achievable at all?
You mean what we are doing is...
Say the trillions which are needed, is that achievable? And then on the other hand, you're now putting in place this taxonomy, which for some may be seen to be rather, I mean, constraining or very difficult to implement.
Well, I suppose we have to try, no? I don't know if anybody has all of the answers on how we're going to get all of this capital mobilized, but certainly the toolbox of measures that have been proposed by the Commission, by the technical expert group as well, and others, are efforts in that direction. But I don't have the answer now on whether or not that'll be enough. Of course, we have to keep the ambition level high and be mindful of not creating any administrative burdens through the taxonomy or otherwise, for example, which would hinder that. Okay, thank you. We move to Scott O'Malley from ISDA, CEO. So Scott certainly has something to add on this debate, and certainly as ISDA will be moving also in this direction, moving the sustainability agenda much more closely. Scott?
Thank you, Carl. I want to thank CEPS, Apostolos, and Carl. You both did a terrific job to develop this paper. I think it perfectly frames the issue of both what's at stake and the opportunities and solutions that derivatives can bring to the table. As Apostolos pointed out, derivatives are a risk management tool, and whether it's financial risk, whether it's FX, credit, interest rate risk, something like that, which is certainly what we'll be exposed to when we build and transform our energy sector to a zero carbon emissions strategy, both in Europe and other places. But it's also a way for end users to get exposure to these new products. And I think those are very important. It's ideally suited, because of it's a risk management tool, to help firms, help investors, and help governments manage climate and environmental risk, which is around us. Whether we choose to ignore it or address it, risk management is going to be a key in dealing with that. Now, I thought Apostolos did identify the four main themes: building long-term sustainable investments over the, using long-term financing is critically important. This is easier said than done. And to your point, Carl, how are we going to build all of the infrastructure, all of the new plants and technologies that we need to transform our current environmental and energy generation base into a greener zero carbon footprint, which is prescribed in the goals of the Commission and in this by 2030. The challenge is enormous because the scale is so big. It is a long-term investment of trillions of dollars, as Apostolos mentioned. So if we're looking at $11 trillion, this is not going to happen overnight. We need to think about making sure that we have that long-term financing in place, which means risk. We have shorter-term investors. They need to get part of a view into this so they can deploy capital as well. And we really need to drive that long-term debt financing, which is so important. And then you have to think about supply chains, whether it's wind turbines from Spain to be deployed in the US or solar panels from China to be applied other places. You then start to create financing risk, FX risk, and then interest rate risk as you finance these over the long term. And then there's also the production and operational challenges that once you have these plants operational, you have the demand side that you have to manage and make sure that your investments are protected over the long term and that investors can both get in and get out of these investments as necessary. So I think this paper really does frame up the opportunity and the challenges, and it does, well spot the green initiatives that this can help with. And I would like to point out and build on what Hannes has pointed out. The Commission has taken a leadership role, no doubt about it, and the important role of developing those taxonomies. We cannot develop a global financial infrastructure, global financial standards without common data, common metrics, common terms and definitions, making sure that across jurisdictions we have a consistent definition of what green is to prevent greenwashing and to make sure that people aren't minimizing the standards and we drive the highest standard. We have to make sure that investors have clear metrics so they understand what they're buying, as well as other investors that are going to that need to put their capital to work. They want to know exactly what they're in for and what the end product's going to be. And changing that or not having that being consistent or well-defined will undermine the effectiveness of this. So I think that's why ISDA is involved. This is something, not only do we kind of look out after derivative markets, but we also want to make sure that we drive those standards, and that's done through consensus. As a global organization, we can bring together people, and we're not the only trade association out there. There are bond associations and loan associations, and they're doing a great amount of work as well. But I think making sure that we have this alignment around standards and labels and terms, making sure we measure activities in the same way, we set targets. I think that the industry has a lot to offer, and we've contributed to the consultations that Hannes had talked about. We think it's important that this is a public-private partnership. Now, we have some experience, not only sustainability, but sustainability of this market. And we've been through a decade of work to improve the regulatory oversight of this market. And since the financial crisis, 2008, 2009, we've engaged in making significant transformations to the derivative markets to make it a safer, more sustainable marketplace. We today have trade reporting of all trades that have been put in place, so we can monitor that and understand the exposure. That's terrific for transparency and risk management. We have capital requirements that have brought over $2 trillion in additional bank safety and soundness, which was relied on in this COVID crisis in March and April, when we had the global financial market concerns, and the financial sector held up very well in spite of a global shutdown. We have clearing in place today, which has been a terrific risk mitigator. And today we have, and it just published these figures just yesterday, but so much of the market is now in clearing, which is a safer form of risk management. 91% of interest rate trades are in clearing today. CDS is about 84%, and those are counterparty and bonds, et cetera, that you're managing there. And then we've also implemented for non-cleared trades a significant amount of, we're putting new margin and both variation and initial margin rules in place. Those are in place, and now we're implementing that in a phased strategy, which has brought, again, hundreds of billions of dollars in additional safety and soundness into the system. And then finally, we have exchange trading, which ties in with Apostolos's, other feature of this, and that's transparency into the market and liquidity. Investors are going to want that, and I'm sure Clive will talk about that as well as Bernard, but making sure that we have good deep liquid markets that are fully transparent. Not only do we have to deliver a greener future, but investors are demanding greener assets. They're demanding greener exposure. And so we have to offer those products, and we have to make sure that those markets are deep and liquid. So let me leave it there. I'm happy to respond to any questions and talk about this further.
Thank you, Clive. If I could briefly have one follow-up question. What is the overall view of your members of the sustainability agenda? Is this for them something exotic, which is still far away? Or are they very kind of well-disposed, very open, very willing to, very eager to learn about this?
I think they have a lot to offer. I think they see this very much in the way that investors have seen it, and the Commission sees it. We need to have a greener future. We need to make these investments. We need to put the capital to work, both from an investor and a supplier side. And in doing so, they think they can contribute to that. Banks and Bernard and both Clive are going to talk about how buy and sell side are going to contribute to this. But we do have a lot to offer. And I think in terms of setting those standards, those definitions, those terms, to make sure that this market really takes off in an effective way. So we're not comparing apples to oranges. We're not have a misunderstanding across borders. We really want this to work on a global basis, because financial markets are global, and we need to put capital to work where it exists and where it needs to be deployed, whether it's in Asia, moving it from money centers in London and throughout Europe or New York. And we need to make sure that we're able to access that capital in a quick way, in a reliable way, so investors have confidence in these markets. And I think that's where ISDA can come in and play a significant role.
Okay, thank you, Scott, and also thank you for the opportunity for us, let's say, to dig into this issue, which also is attracting our interest. So we move to Bernard Koopman from ING, who will speak from a sell-side perspective, how these kind of derivatives markets can contribute to sustainable finance. On top of that, Bernard comes from the country which is probably the most advanced in implementing this agenda. I think we're most also academics, at least in Europe, are active on this field. So Bernard, we're eager to hear what you have to bring in on this point. Bernard is not on video, but is on the call.
Yes. Hi, Karel. Thank you for the invitation, first of all. Secondly, I'm from Belgium, just as you.
From Belgium? Very good.
But I work in Amsterdam. So the main, I would say, the head office of ING is situated there. And when we talk about ING, you're spot on. Dutch banks, and especially ING, has sustainability and innovation as strategic terms in its strategy for the last 10 years. Why am I saying that? Because it's an important part of where we would like to be and where we stand in the developing sustainable finance spectrum. And this is for us, just as for other players in the market, a bit the Wild West. It is unknown. Everybody's trying new concepts, is looking at what is going on. And now with the Commission coming out with a taxonomy, new standard is being placed. ING always wants to be in the dark green spectrum of this market, meaning that we have a big fear of being seen as greenwashers, because there is a big marketing value in sustainable finance, in green derivatives, and everything which is sustainable these days. So you have to make sure that everything you put out there can stand the test of time. That's why we work together, because I'm running a team of global product specialists in financial markets. We are responsible for product development, and we traded the first sustainability improvement derivative with a Dutch client, which got some press release last year. Why am I saying that? We are pretty good in financial markets in structuring derivatives and putting new things out there. We developed the SIT, as we call it, the Sustainability Improvement Derivative. I think we put it together in 3 days, but it took us 15 months to get it approved, because there are a lot more players out there that needs to play ball with you. Notably, there's ISDA, there is risk management, there is internal stakeholders, and one of the most important stakeholders that we have internally is sustainable finance. Why do we mention that? Because sustainable finance has an experience of 10 years plus in dealing with questions like, what is sustainable? What can we define as green? When do you say that a sustainable improvement KPI is that, when is that measurable, meaningful, objective, and will that have an impact for the future? So in everything what we do, we, the markets people, the derivatives people, we work together with the people who have the knowledge about this market. And we came to the combined approach that looking into the derivatives market, there was a clear opportunity to step into, and it was not a green derivative, it is a sustainability improvement derivative. Why am I making this distinction? There are two streams in this business. You have the green bonds, green loans, where the assets or the proceeds of an investment are being used for sustainable or green projects. What we have seen is that we have a limited amount of these projects and these deals around. And they have been identified, and we're working on them. But in order to get to the next level and to get to the 2050 Paris agreements and to become a carbon neutral continent here in Europe, you will have to do more, okay? You will have to take a step, and you will have to work on transition, which means that companies that are not seen as sustainable today need to get an incentive to work their way towards a transition and to become more sustainable or even green in the future. And that's where we step in, where we developed a product that is the SIT, as said before, where we implemented a mechanism. And the beauty of the products, or the genius, is in its simplicity, is that we added within the margin that we take on top of the mid rate of a derivative. As you know, there is a mid rate, you have trading costs attached to that. And then more in the technical part, you have credit costs, funding costs, and capital costs, plus an operational margin that you need to put in. Well, we are able to play with that. We are able to put a sustainability improvement element in there, which makes that a client, depending on achieving these KPIs, will get a discount, will stay at the same level, or will get an additional top up on the margin that he's paying on the derivative. All of this depends on the KPIs that have been set out at the start of the derivative, okay? And deciding whether a KPI is meaningful, objective, measurable, that's something we do together with our colleagues from sustainable finance. You can imagine that there is a danger that a company will say, I need to do something about my sustainability. I need to do something about my marketing. Let's do a green or a sustainability improvement derivative. Let us plant 100 trees, and then we get a discount on our derivative, and everybody is happy. That's not the way how it's going to work. Basically, you need to make sure that over a longer period of time, you accompany these companies in their transition towards a meaningful contribution to a more sustainable future. And therefore, these KPIs needs to be, and they depend heavily per sector, They need to be objective, measurable, and auditable at the end of each year. Therein, there's also embedded that a sustainable improvement derivative, as we have them now in the portfolio, will run over a longer period of time. If you would say, I'm going to offer something on a 3-month basis, the KPIs linked to that, which you can fulfill in 3 months' time, will already tell you that there are low-hanging fruits and that it's debatable and questionable whether these KPIs will be meaningful and have a real impact on getting the world or Europe to start with more sustainable. So that is basically the product, how it works. What is the market? Maybe a few words from the market, what we have seen, and that's quite interesting, because I told you in the beginning that that it took us 3 days to structure the product and 15 months to get it approved. There was some hesitation as to what extent this product can contribute, meaning that the discussions we are having on a policy level, what is deemed as green, what is then sustainable improvement, and what can we accept or not. And a lot of our colleagues had a fear that we were going to be greenwashing, that markets people would simply do whatever needs to be done to get the swap sold, and that the whole market then would deteriorate and that we would miss a tremendous opportunity to get a meaningful impact on the business. Well, in that sense, this point has been addressed, this point has been looked at, and the funny part is that a lot of the clients we talk to on sustainability improvement derivatives, they actually give us feedback that they say, this is quite interesting because you can target it on the KPIs where we believe in. We are talking to a brewery, for example, that told us texto that we don't want to do a green bond because everybody in the market can do a green bond. You have energy suppliers that are burning coal, they can issue a green bond. Whereas we feel that we need to be true to ourselves, and by looking at the product you have presented to us, we can adapt that to our own KPIs where we strongly believe that we can be impactful for the coming generations. So that's a flavor of the market, which is currently developing at a very fast pace. I must admit that COVID-19 set us back a little bit as there was a lot of distress and need for liquidity in the months that came. But we see the requests and what has been going on coming back in big speed, which pleases us much.
Bernard, can I ask
Happy to take any questions?
Yeah, sorry. I have a quick question on, is there enough collateral or underlying assets for your products? Because we know, let's say, that what is effectively green, as you were saying a moment ago, is extremely limited until today.
Yes, but that's the fun part, Karel. We don't look at what is green. We look at the KPIs. So what is a company putting themselves out there to become more sustainable? And if that is impactful, I give you an example. A brewery can reduce the usage of water by 30% by implementing innovative ways of brewing. One could say that a company has decided that the whole car park will be transformed into full electric use of electric vehicles in the coming 4 years. This can depend from sector to sector. This can go from shipping to rigging companies that are changing their energy supplies, what have you. And that's the beautiful part of the product, that it can be applied on an ad hoc basis on an OTC, over the counter as we call it, and it can be structured at the wishes and the developments on sustainability area per client.
So you're not waiting for the taxonomy, or are you?
No, we are not. We're a step ahead.
Okay, that's a very important point. Clive, we turn to you, an asset manager. Clive is from Invesco. So how do you look at it from your perspective? What do your clients want? Do they want to become more green in their investments? And do you find the products?
Yeah, I think this is fascinating. I firstly wanted to echo Scott's comments I was only invited onto this call earlier this week, and as a result, I read Carol and Apostolos' your report only yesterday, and I have to say I thought it was excellent. I thought it covered the topic in great detail, was incredibly readable and logical. And to me, the topic of this conversation that we are having is what are the role of derivatives in sustainable finance? And to me, it's an unbelievably simple discussion, because derivatives have been developed over, well, decades and millennia, as illustrated in the note, to help facilitate financial or investment decisions. So why would we not want to use those in terms of sustainable finance and sustainable development goals? Why would we want to hamstring investment into sustainable areas of the economy by not having the toolkit, the diverse toolkit that has been developed to basically help that investment goals? Now, that therefore means we may need to reiterate why derivatives are good. They tend to have this view that, you know, from some regulators and some other aspects, that derivatives are bad because they add leverage. Well, yes, if used in the wrong way, you know, anything can be bad. A knife in the wrong hands is not an implement to eat your food with. It becomes deadly. So the key to me is that we need to work out why derivatives are healthy. And the note details them in great detail, but you know, they are there to basically enable people to be able to hedge, to be able to mitigate risks, to be able to transfer risks from one part to another. And those reasons for derivatives are incredibly valuable for all types of investing and hence sustainable investing. And I think it is also important, and I've seen a number of the questions, is to distinguish in my mind, and I think in maybe in other people's minds, the difference between a derivative, which at its core is an instrument that derives its value from the performance of an underlying asset, and what will be ESG derivatives, which will basically be new types of products that develop and focus specifically on ESG risks. So we understand there are derivatives for credit, for interest rate risk, etc. We will see, and we've already seen some, and the questions were what has been developed. We've seen weather, emission allowances, renewable energy certificates, low sulfur, oil contracts, and other underlying asset classes will develop to mitigate those sort of risks that are inherent in the regulation or inherent in the development of a sustainable economy or the development of a taxonomy economy. Now, to me, though, we also then have to distinguish to normal derivatives, standard basic derivatives like swaps and futures, which will just exist as a product above that. And what I think is key for people to understand is I don't need regulation on the standard derivative. I need classification of the underlying. You know, we already have the metrics for what futures and swaps and options and puts are. I don't need new regulations on those. But what I do need is, as Scott very clearly said, is that the underlying needs to be incredibly well defined so that we don't have the concept of greenwashing, the concept of lack of information. And we do need common metrics and common views. But that is of the underlying, it isn't of the derivative. So, you know, I take a view that, you know, in asset management, you know, I manage a multi-asset fund with my colleagues in the Henley investment team in Invesco. It's about a 15-16 billion euro fund. We have, it's an absolute return fund. We could not manage our fund without the use of derivatives. We delivered only, our performance in Q1 this year was minus 35 basis points. We couldn't have done that without the use of derivatives to mitigate risk. We couldn't have had the same trading capacity without some of the liquidity aspects that those markets provide us. And it's interesting in terms of leverage, which is often called a criticism of derivatives. We offset some of our credit risk through the use of CDS because the liquidity in single stock credit was weak. But in terms of the CDS market, we could gain credit exposure. So we actually added leverage to the fund to mitigate risk at a time of crisis. And that, I think, is really relevant. So in terms of usage for an asset manager, clearing, it lowers counterparty risk. If one can do that in terms of mitigation of risks for ESG products, but we've got to delineate again, ESG products in terms of a passive, index, which people can invest in, and then being able to have derivatives based on the passive index, or instruments that are very specific to the factor risk of ESG. And I think that delineation is important. So I'd sort of just conclude, because I don't want to go through the list of what the benefits of derivatives are, because hopefully that's a well-trodden path and understood. But what I would say is that their derivatives do have huge benefits, both to asset management companies, but also to companies, and long-termism, which you mentioned in the note, I think is a key one, because it enables people to take longer-term decisions and smooth cash flows in their analysis of their investments. We do need to delineate between those two types of sort of derivatives in terms of what I call standard, usual formats, and then actually specific ESG factor focused ones. And I think we do need to have this focus on fundamental metrics and data, but that needs to be done at the underlying component, not at the derivative component. So those are some of the thoughts I've had. But again, I just wanted to thank Carol and Apostolos, because I thought your report was I have agreed with nearly all of it, but I think it's a good discussion point. But I do think it's important for regulators to understand that derivatives are not bad. They are a fantastic tool for facilitation of investing.
Thank you, Clive. So you're using already, you have probably ESG usage for which you use derivatives as well. I mean, usage which are basically investing into green assets, where which you have as a risk management component, derivatives.
Well, you can use derivatives to gain exposure. So you can buy, you can gain exposure to market. It doesn't have to be just a risk mitigation factor. Derivatives can be used by market makers to help facilitate the depth of markets. Without derivatives, you'll often find people won't be willing to trade the underlying because they can't offset that risk. Yeah. So there are multiple uses for derivatives. Risk mitigation is one, active exposure and gaining exposures to market is another. Obviously, as I just mentioned, in terms of market makers is important. But I'd also go as far to say is that, for us, lowering the volatility, but relaying risk. And I think that is, for us, in terms of what we use it today in our fund isn't a green fund. We are looking at ways to develop that. We have a fund that integrates ESG integration, but it isn't a sustainable fund as such. So we don't need them today for the existing fund. But clearly there is an incredible demand in the market to develop those. But that is the underlying investment. It isn't the derivative market. The derivative market will develop on top of that to mitigate those risks and provide instruments to help you offset those factor risks that you need to do. But I mean, if you're looking to build a wind farm, you've got to offset your long-term duration exposure and your interest rate costs. Yeah. You're using a derivative to do that. If you're wanting to basically have a long-term view, you might be having a long-term forward in the energy market to offset your long-term cash flows. Derivatives are prevalent everywhere. They're not, this nascent only used in risk mitigation. Scott, I can see you nodding your head.
No, Clive, it's very useful, very, very interesting, and adds well to this debate. We've seen already some questions on the Q&A. I mean, there is one probably which I could ask to Apostolos, on how, to what extent derivatives can help in this transition from, for example, brown coal towards more, renewable energies. I don't know, Apostolos, whether you have a response to that?
I'm with myself. First of all, I'd like to touch a bit about Clive, what said about the ECG component. Let's say it's important to make the distinction between standard derivatives within an ECG construct and ECG derivatives. And the former are considered an essential, let's say, tool, a risk transference tool, without which large-scale capital raising would be more inefficient, while ECG derivatives can help develop the transfer and price discovery of ECG-related risks. So that's to add a bit to Clive's point. Now, your question, Karel, was about the...
To what extent, let's say, that somebody asked to be more specific, let's say, how derivatives can help to finance transition from brown assets to renewable.
I think I answered this, but I mean, Bernard answered this question during his point, during his intervention. So he touched about that with some examples. But it is important also to highlight also another point about the use of CDS. I mean, CDS have been perceived as, Clive, you said, perceived as a kind of a instrument that promotes short-term approach or short-termism. And this is something to differentiate and to tackle this issue that can indeed be very helpful instrument to, let's say, tackle or transfer credit-related risks. And this is also something important that we highlight also in the report.
If I can ask Bernard a specific question, somebody asked whether your traders, how the green risk is hedged for, whether for these investments which you make in green derivative products, or whether you take the risk on your books yourself.
Well, I think there are markets people in this webinar. It's a question we received multiple times. The simple answer is we keep it on the books. Currently, there's no market or existing market where we can offset these kind of risks and where we can sell down our risk that we're taking on the book. Again, we have a strong belief that sustainable companies will be the winners of the future, although we cannot empirically prove it because we don't have the data yet. But it's a bit, in my belief, and now I'm speaking on a personal note, it's like when scientists were starting to say that the Earth was round instead of flat. Okay, they couldn't prove it at that time, but we all knew that it was there. And I think in the future, if we see how the development is going on, the big rating agencies that are now entering the ESG rating space, the consolidation wave that is upon us, I think this will be part of a normal credit process, that ESG factors will be part of the normal credit factors that we take into account to assess credit risk. The minute we have that, and then if we then have an additional layer of policy making on top of that, where capital requirements, for example, for green investments or for green derivatives based on a solid taxonomy could come in, then we have the true ingredients and recipe for a successful market. But that's when all players in this market come together, shake hands, and make it work.
I mean, if I can follow up, Bernard, because this links, there's a question which links to what you were saying, whether it would be helpful to have a real value on some specific assets, environmental assets like clean air, like water, which you mentioned, fertile grounds, etc. in this process. Would this be useful, or is this there already? I mean, do the markets provide for this or not?
This has been tried before with some sort of success. We're looking into power trading, carbon trader, emission rights. Electricity is an important part of the energy transition. So these are all developing components. And ultimately, a good functioning market, as previously stated by all stakeholders here, is a prime, I would say, condition that you need to have to get something going. Is it there already? No. Will it help? Yes. But then you need to have some sort of incentive from government agencies and also from the market that we talk business. And the minute the money starts rolling, then you see that you come at a certain point of no return, where this market, and I truly believe that the green market, which is now a bit outside of the framework, will become the mainstream market where people will be looking at. as we can run, but we can't hide this. If you want to get this ambition somewhat realistically done, then it's time to act.
But that is part of the taxonomy as well, which we discussed. I mean, like water, let's say these resources are part of the definitions of the taxonomy.
Exactly. So it's a tremendous step that the EU is again putting a step forward and showing the world like this is the first, I would say, benchmark, the first line we put in the sand, and up for the rest of the globe to see if they accept, if they don't accept, and have the discussion going. But this is basically the benchmark where everybody was looking at to avoid greenwashing. And I think this will be, as all legislation, this will be a developing and a living process. What is green or considered as green in the cement industry, for example, will maybe in 15 years' time with new technologies not be considered as green. But at least we have a benchmark now where we can start comparing sectors and apples with apples. If you're going to compare a wind farm project with a oil rigging company, well, you know who the winner will be. But under the oil rigs, you would like to have that the most sustainable or the less polluting ones stay afloat and become the winners of your current transition where you're in. So we can't see this thing, in my view, as a black or white process. It is gray, and we have to move up with the whole economy towards the more sustainable side of things.
Scott, there was a question for you as well, whether ISDA will come up with definitions, language, to cover the green aspects of derivatives?
Well, I think there are a number of definitions being developed already. We'll certainly take part in that and make sure that they align with our documentation, which people commonly use to document their trades and their risk management tools. So we'll definitely take part in that conversation, and it will be a conversation that will be with the industry and part with the official sector, and that's appropriate to make sure that we're fully aligned. Our challenge, and what you can count on ISDA to support, is that cross-border work as well, to make sure that what's being developed in the European Union is consistent across other jurisdictions as well. Right now, those conversations are going slowly because not everybody's in the same position. China and the EU are two of the leaders right now in terms of green bonds, and making sure that those line up and make sure that we get high standards from that is important. But there are a lot of things in this area, making sure that we get the right proper treatment for accounting. Prudential regulators are going to have a say in what risk looks like and how they're going to manage that on the bank balance sheet. Making sure we understand what that risk is. These are not risk-free assets, and that's why we're trying to manage that risk. But we're also thinking about the capital treatment. We certainly want to incentivize it, but we don't want to ignore the risk associated with it. I had some experience when I worked in the U.S. Senate. We were incentivizing debt financing for green energy projects through loan guarantee. Just because we threw more money at it didn't make it any less risky. We have to do this with our eyes wide open and making sure that we get the right balance here, and not throw out good risk management in favor of what we all desire is a cleaner, better environment. But we got to do that appropriately and make sure that we get the right responses here. We certainly don't want to have a setback because we get the risk management wrong here. We have to do it carefully and fully aligned with other regulators.
I mean, related to that, there is a question, because you mentioned clearing and central clearing, but some people said, look, I mean, some of these products, derivatives products, are not centrally cleared. They are bilateral, and so the counterparty risk is higher.
We have
no problem from that perspective.
We have ways of dealing with that. Right now, we have initial margin and variation margin rules that do charge a higher rate for non-cleared trades. We have some of the most sophisticated risk managers in the clearinghouse, and they're going to be terrific assets as we model this and look at the risk exposure and look at it from a portfolio basis.
But that makes these products more expensive, Scott, if you're not centrally cleared, or not?
Well, there's a liquidation requirement. It could be more expensive for non-cleared, non-standard products. But not every interest rate product is traded on exchange, but we can clear. Today, we're clearing 91% of them. So it's the risk and the methodology that you're thinking about. It doesn't have to be a standard product to clear. It's understanding the risk that it brings to the clearinghouse and the exposure, the counterparty exposure. And those can be
Okay.
modeled,
Yeah.
and we'll get better at that. And I think that's a good conversation to have about what this risk looks like. And we're prepared to have that conversation and move it forward.
Thank you, Scott. A question probably for Bernard. How does the mark-to-market work for green derivatives? Or is there a green discount?
It's the mark-to-market works as a normal derivative. What we're trading is a plain vanilla IRS or a cross-currency swap, as you wish. And what we're doing is at the end of the year, we have a period where we will be looking at the annual report of the company as such. We will see if the KPIs are met. If that is the case and the annual report is audited by auditors externally approved, we will amend the trade, meaning that the fixed rate, for example, if a corporate is hedging a floating rate loan, that the fixed rate will be deducted by, that can be 0.5 basis point, 1 basis point, depending on the tenor of the trade and the risk we are taking on the counterparty. And we will amend the existing IRS, meaning that a new confirmation will go out. So basically the mark-to-market statements of that derivative will be exactly the same as a plain vanilla IRS. So then the follow-up question that normally pops up now is that a sellable option or optionality that you have in the derivative, the ESG part of the derivative? No, it's not. It's a bilateral commitment that we have with our clients, that we take the risk on our own books because we can't hedge it away. So basically meaning that on this OTC derivative, the client is not able to monetize the optionality or the ESG optionality that is embedded in the derivative.
Okay, thank you, Bernard. Very clear. There was also a question about whether, of course, a bit related to what I asked to Scott already, but I could ask it to Apostolos, whether there is a need to have in EU regulation a more precise definition of sustainable or ESG derivatives. Would this have to be clarified at the regulatory level? Of course, this is probably part of this taxonomy debate, but it's going much more into detail. Apostolos?
Yes, I think it would be necessary to clarify these things because as we discuss all this time, it's not easy to understand. It's not easy to distinguish or to make the argument of how a derivative or what is an ESG derivative or what is a climate derivative, for example. So clarifying all these different things and options would indeed be necessary for both investors, advisors, investment funds, and all other institutions that they are using this kind of instruments.
There was also a question probably to Clive, let's say whether we need more innovation in product design and use of derivatives and product design for investment funds, insurance contracts, pension schemes?
Yes and no. I think what is interesting, one of the key aims of these conversations, we forget the client. And at the end of the day, the client is who puts the capital into this, to the beginning of this funnel. And there are a wide range of clients and what they want to put their money into. Normally their capital, they want to invest it. And what we see as asset managers is an incredible variety, a spectrum of different needs. And I try to avoid using green anymore. I try to use sustainable because the reality is the spectrum is across sustainable. And I'm a very significant fan of the stakeholder economy and the longer term move away from shareholder profit maximization as the key driver and dynamic. But that's my view. And I meet clients who couldn't care less. And when I go to the US, it's amazing how few people care about climate change. And if you tell them that the product is going to have a climate, they'll just pay no attention and will not want to put the money in.
Yeah.
So what I want to do as a client-centric person is to provide a range, a spectrum of products which sate the interests and requirements of a variety of colleagues. I don't want to lecture my clients on where they feel they should appropriate their assets. I don't want to go to a Middle Eastern clients and tell them that their Sharia law approach is wrong. That's right for them. There are different metrics and merits. As a result, the question asking, should there be a variety of resources and both products and instruments to use? Absolutely. It's one of the things that we at Invesco have been slightly pushing back on the EU in terms of not wanting to have a very narrow description of what is an ESG product, because it has to do everything. Our view is I might meet a client who only wants a certain component of that, and I want that to be considered ESG because it might be focused on, you know, the gender diversity. It might be related to CEO pay in relation to the industries they want to invest in. I don't want it to have to be everything, because the minute I start adding everything into the pile, then I guarantee you that the financial returns are probably going to be limited. And people still care about the financial returns. As, you know, there will be impact funds which might be towards the more charity aspect of and focusing on the impact return, but the financial return still has to be relevant. And I can guarantee if we start applying money into sustainable projects that just lose money, as Scott mentioned, you still have the capital risk. You can't just give money away. That doesn't change the profile of the investment. Then this will die a death. And we need for this to be attractive in terms of the range and the spectrum, but also in terms of the returns. Unfortunately, at the moment, because of the consumer-led demand of this, which I think the EU is representing very well, but it isn't just a regulatory framework, it is an underlying demand for greater sustainability by all clients, and I mean consumers and buyers of products, and as a result, that is improving. You can see it in terms of returns when you do basic ESG. I think HSBC did a recent project where they modeled 1 million different portfolios and added in it sustainable goals and metrics to it, and it literally raised the risk return profile across the entire spectrum. That's great. If you can increase the risk and return profile by adding in these components of sustainability, yes. Do we think we'll need greater product design and development? Absolutely. I think, as you can hear on the call, this is a focus for all. And, you know, internally at Invesco, we've got lots of products that are being developed to bring to market because we can see there's a demand for them.
Clive, can I follow up? Is there a risk with Brexit of diverging on the EU standard? Or probably you can ask Scott in a moment as well.
I would have thought definitely. I can't imagine that the depending on where we get to on Brexit in terms of hard or soft or some sort of alignment. Having my father was a politician for 44 years. He was the treasurer of the OSCE. He was on the North Atlantic Assembly. He was a massive Europhile, as am I. So I don't want to necessarily to touch on a subject that's maybe slightly against my viewpoint. But clearly, there may, you know, if regulation is seen as a cost, as an inherent restriction, the British have tended to be generically quite more in the terms of deregulation. Do we therefore, you know, who knows is I think the simple answer.
Okay, Scott, you want to have a last word on that? We're almost towards the end. I know it's very difficult for you to pronounce yourself on that, representing ISDA.
Well, we're going to make sure, one of our goals is to make sure that we have alignment, whatever the jurisdiction is, to make sure that these function as well as they can. I'm going to be watching the U.S. presidential election coming up. Joe Biden, the vice president, just laid out his green agenda, and he's talking about putting $2 trillion in government funds behind kickstarting a very green agenda and adhering to goals by zero carbon emissions by 2035, which are very consistent with where the European Commission's going. They're going to need these tools. They're going to need standards. They're going to need, a common metric and ways to measure progress and development. Bernard and his company is actually putting their money where their mouth is and taking on these investments. Clive and his customers will do the same. So we have to make this market as transparent, as functional and clear as we possibly can. And then I think the investors take it from there. It's exciting. We've got tremendous advantages now with the price of green energy coming down. So this is in our future. This is totally capable, but it's going to take a massive amount of capital and investment over a very long period of time to deliver it. And we just have to put the conditions in place to finance that. And it's not something that's going to be easy, but it's definitely worth doing.
Good. And with this, I think it's a good closing word. Thank you very much, Scott. Also, thank you for the cooperation with us, let's say, on this study. Thank you to Clive. Thank you to Bernard for their contribution, which was very interesting, added kind of a real life touch to this debate, to what we did, Apostolos and I, a more kind of whatever theoretical study about derivatives and sustainable finance. Also, thanks to Hannes, who's no longer there, but also who helped us to understand how this fits with the EU's agenda. So we had about 150 participants. I would like to thank them all for listening in, also for the questions, many interesting questions. Also, the debate is still available on YouTube. So for those which were not able to follow it, you can send the link to your colleagues if they were interested to follow this. But also, as I said, the study is available on ISDA's and CEPS website if you want to consult it. And if you have any reactions, we are, of course, very interested to hear your points of view. But I also learned a lot again from this seminar. We could add a few pages to the study after this, because it's always useful to have these real examples from the market people, how these things are used on a day-to-day basis. So with this, thank you very much for listening in, and hopefully we can work together again. Scott, thank you.
Thank you.
Thanks, Clive and Bernard and Apostolos.
Thank you.
Thank you very much. Thank you, Carl.
Bye-bye.
Bye.
Thanks. Bye.